The biggest roadblock to buying property in Australia is your borrowing capacity and the ability to get a loan. In this video, I'm going to share with you exactly how you can increase your borrowing capacity because your brokers probably haven't told you, and I'm here to share it all. So if you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, if you are new here, I actually run one of Australia's fastest growing buyers agencies. I started it about 5 years ago. We've scaled up to a team of over 50 full-time staff, and we purchase about 20 to 25 properties every single week. So when it comes to real estate, we are on the ground and we are actively doing this for clients. That's why I have this YouTube channel, to share more insights with you guys so you can either take that information, do it yourself, or if you need the help, definitely do reach out. I'll leave a link in the description box below. Now, when you are going out there and purchasing property, it's only possible with leverage, which is you getting out a loan. Now, we have interest rates starting to fall and we are expecting in May for another rate cut. Every time the rate cuts, our borrowing capacity actually increases. And that's because when the banks are assessing your serviceability, they're going to do it at the cost of borrowing plus about 3% as the buffer. So if the interest rate is 6%, they will assess you at 9%. But every time that rate drops, and say it goes from 6% to 5%, they're now assessing you at 8%. And that's going to make a significant difference all the way up to anywhere between 15 and 20% increase in your borrowing capacity. So keep an eye out for what's happening with interest rates, as we are expecting the interest rates to fall quite drastically over the next 12 months. In fact, I made a video on this channel not long ago that you can go and check out here, why I explain one of the major lenders here in Australia are expecting interest rate cuts to fall rapidly over the next 12 months, and there might be a possibility of 150 basis points to be cut off the interest rates currently, which is going to be absurd. Now let's dive into some things that you need to pay attention to. One of the things is HECS. Now this is one of those things where you don't really care about it because it just appears in the background, you got uni for free and you're loving life. But what it does is it silently kills your borrowing capacity over time. And it doesn't matter if you have $100,000 worth of HECS or whether you have $5,000 worth of HECS, because it's based more on your income rather than the amount of HECS you have. And what I mean by that is depending on how much you earn is how much you're required to pay back for your HECS. So for instance, if you make $100,000, you're expected to pay a lot more in terms of paying down your HECS versus someone who makes $45,000. And that has a gradual scale up. Now, what's really interesting is a major lender has come out and suggested that maybe as part of their servicing, they're going to disregard HECS. It is so important now more than ever to have the right education and the right people in your circle. Because if you don't know about this information, it could stop you from getting into the market. Because say you went to your bank and they said, well, no, you don't have the capacity right now. 3 months pass by and you have no idea of the changes in policy and what other lenders are offering. This is why it's so important that you have the right mortgage broker, because they're going out there looking at policies and looking at every single lending institution that's out there. If you want help in refinancing, getting some equity out, and just structuring it out properly when it comes to investing in property, then definitely use the link in the description box below where you'll find the mortgage brokers that most of our clients are actually using today. The other thing I see a lot of people do is they go and chase the lowest interest rate. Now, I did just mention that if you have a lower interest rate, it increases your borrowing capacity. But in order to get into the market, you need two things. One is the borrowing capacity, so the ability to borrow, but you also need a deposit. Now I'm going to use an example here because it's going to illustrate exactly what I mean by this. So you have lender one that gives you a borrowing capacity of $600,000, but let's say you have a property and you want to get it revalued. That property at lender one is getting valued at $600,000. And based on that, based on your current debt, let's just assume that you have an 80% debt on that, which is $480,000, you have $120,000 worth of equity. But if you can only borrow 10% of that, because most banks will go up to 90%, it means that you have $60,000 available to you. And let's say that lender has an interest rate of 6%. Now, lender two has a higher interest rate. It's 6.5%. However, the valuation that they can give you on that property is $660,000, which is 10% higher. Not only that, but they also give you a higher borrowing capacity because their servicing calculator works differently. So in that case, you're actually able to borrow $650,000. So with lender two, although the interest rate is higher, you actually have the ability to borrow more for your next purchase, but also you have the ability to go and revalue your home higher, which means you get more equity out in your pocket. And that could mean the difference between you buying today versus waiting 6 months after interest rates have cut, and then you're having to buy the same property for 5 to 10% higher. I've seen this time and time again, And the difference between what lender 1 can give you and lender 6 can give you could be hundreds of thousands of dollars. And I know this sounds crazy, but I've seen it happen with my own portfolio. I've had the same property that was worth $450,000. If I looked at comparables, probably worth $480,000. But I go to 3 different lenders and the lowest bank val was $460,000, but the highest was almost $600,000. So stop chasing the lowest interest rate. You need to know how you can position yourself to get the desired outcome, which is you want the property, you want the portfolio. So if you get attached to just the lowest interest rate, I'm sorry, but you're probably not going to make it when it comes to scaling up the portfolio. You need to look at what lenders are going to give you what you need to be able to execute on your plans. Next up is get rid of those credit cards. Now I know the first thing you're going to say is, Ravi, I pay off my credit cards all the time. Also, my limit's like $2,000, so who cares? Well, I'll tell you who cares, the banks. The way they assess liability is they say, okay, yes, John goes and gets a credit card and the credit card's paid off in full. In fact, there's no balance owing on it. They're still going to say, if tomorrow I give you a loan for your home loan, you could still go out there and use the $2,000 on your credit card. So without me knowing, I'm just going to assume that you have $2,000 worth of credit card debt that you're already using. So by just eliminating that, you're going to slightly increase your borrowing. And this does make a difference because you might think, well, what's $2,000 going to be or $5,000 on my credit card? It could mean the difference between you getting the property you want versus not getting it. Now, if you look at it in minute detail, you might be able to extract a little bit of money, but that little bit of money allows you to go and renovate the property, which increases your rents. This is how you've got to think. Every small move does compound over time. Now, if you have got some value from this video so far, smash that subscribe button because I bring out videos every single week and I'm bringing it out with the purpose of you getting educated and getting ahead with your finances when it comes to real estate investing. We're on a journey to get to 100,000 subscribers and I think we can do it in the next couple of months. So let's make it happen. Next up is replacing your bad debt with good debt. You've heard this before. Bad debt is unproductive debt. Good debt or productive debt allows you to scale up your portfolio even faster, and it's usually associated with assets. So if you think about bad debts, you're going out there using a loan to get a car because maybe you need it for work or you just want to look fancy. That is unproductive debt. Usually with a car loan as well, you're going to have a higher interest rate compared to your mortgage. So if I go to the bank tomorrow and say, hey, Mr. Bank, I actually want to go and borrow some money. They'll say, cool, what's it for? I'll say, it's for a car. They say, cool, it's 12%. Okay, maybe I just need a credit card to be able to buy something. Cool, the interest rate's 21%. Okay, but what happens if I buy a house? Oh yes, come please, we'll give you 90% of the loan and you only have to pay 5 to 6% as an interest rate. How good's that? And usually the dollar figure on the house is so much higher than it is for the car or the personal loan or credit card that you're gonna get anyway. So be careful when you do take out debt, it's attached only to productive assets. Now, the way I personally like to think of life is, yes, you need to live in the now, but you also need to invest in your future self. So by going out there and buying the house and foregoing the car right now, in case you already have a car, maybe you can just use the metro to go to work, you might say, okay, I get the house, but maybe in 12 months time, I can take out some of that equity and get the car. And that way you've got best of both worlds. You're in the market, it's growing productively, and now you've got the car as well. Or you might think, well, I don't actually need a car or I don't need that personal loan. I'm gonna keep building up my portfolio. And you might decide in 10 years time to sell one of those houses, go on the holiday that you want, go and renovate the place that you're living in, and also get the car and the nice toys. Delayed gratification is the game here. Speaking of delayed gratification, rent vesting your dream home actually makes a lot of sense. So if you go out there in Sydney and say, I want to buy a place and it's going to cost me $3 million, chances are you're going to wipe out all of your borrowing capacity to go and purchase that one home. Now, yes, you do have your one home. You have the monthly repayments, which you're absolutely going to hate for the next 30 years, but you have your own home. And I totally get why that is appealing. However, if you have a way to go and live in the dream house, plus acquire assets and keep growing your wealth, you will be in a significantly better position come 5 to 10 years time. Because ultimately, you still get to live in the dream house, in the dream location, but it just means that you don't own the house. And that's okay, because what you do own is a portfolio of properties that allows you choice. And you might decide, maybe in 5 years' time, as those values of those properties go up, I may decide to sell a few, use the deposit to purchase the dream house anyway. Now, of course, there's going to be borrowing capacity limitations, and that's why you need to have the right strategy and be fluid with how you go about acquiring your assets. I know this works, and this is probably the strongest strategy out there when it comes to building wealth in your 20s and 30s is rent vesting. If you have the ability to do it, I urge you to go and do it because it's exactly what I've been doing over the last 5 years, and I've been investing in property for 11 years. And I have so much more choice now than if I had just gone about and bought my dream house, say 5 years ago. Next up is extending your loan terms. And people don't want to do this, and some people don't even know about this. So let me explain. When you go out there and get a home loan, you're usually going out and getting a 30-year term. So that just means that over 30 years, I'm going to stay with this bank, I'll probably pay principal and interest, and I'll pay it off in 30 years' time. So when you go out there and say I've purchased a place 10 years ago, today my term would be 20 years remaining. But what it does mean is that when the banks go in to service your loans or look at your serviceability, they'll say, okay, well, you have 20 years left to say pay off a $500,000 home. But if I go to my broker and say, look, I want to maximize my borrowing capacity, instead of $500,000 being paid off in 20 years, can we extend that term out to 30 years? And that means the repayments will drop. When the repayments drop, that means you have more in your pocket, which means you could service for a bigger loan later, which means you will be able to go out there and buy a bigger home or be able to invest in that extra property. Now, the counter to this is that if you're extending the loan term, it means you haven't paid off your house in 20 years. It'll extend now for another 10, which means effectively the 10 you've already paid off, you're going to extend, and now it's going to be effectively a 40-year loan, but on a 30-year term. And with that means you're accumulating a lot more interest as well. So if you're not comfortable with that and you don't understand the strategy, it's probably not worth it for you. For me personally, I want to acquire as much as I can because I know the interest I pay is so little compared to how much gain I can get over the long term by being in the market with the maximum amount of assets. And the way that these 20 and 30-year loans work is that after year 5 to 6, if you've purchased well, the properties will become positive cash flow, which means not a single dollar will come from your pocket into the property. And from years 5 to 10, it's going to increase in terms of how much income you generate. And that's when you can go in and start paying extra towards your loans. You could still effectively pay it off in less than 30 years because you go from accumulation to consolidation. This is why it is so important that you just don't go out there and just buy a property and then maybe I buy 2 and maybe I buy 3, happy days. To get filthy rich, you're going to have to get to 5+. There's less than 1% of all of Australia that have more than 6 properties. So in order to do it, you need to do it the right way. And that's why you need the right people guiding you in this. Otherwise, you're going to fall flat after 2 or 3 and say, well, it's actually impossible right now to be able to build a portfolio. And I can tell you now, it is still possible to build a large portfolio. In fact, this morning, we've just had a client that's come back and signed on for their 10th property. It's absolutely amazing when you see the journey that this person's taken from their first property now to 10 properties, and they should settle on the next property within the next 2 months, which means in the space of 4.5 years, they've got 10 properties in their portfolio. So you know who you are because you're probably watching, so well done. And the final point that I'm going to make around borrowing capacities and how to do this properly is if you look online, a lot of people, brokers, buyers agents, and everyone in between are talking about trust structures. If you want a detailed video about this, I'm going to make one if I get those likes up to 300 and you comment down below saying trust video with Ravi. I will make that video, proper whiteboard session. We're going to make it boring, no edits, and I'm going to show you step by step how this can work. Because there are pros and cons, and yes, you may unlock unlimited borrowing, you need to know how to do it the right way. So again, I'm putting it out to you. If you want to see that video, 300 likes and comment down below saying trust with Ravi, and I'll make that one for you guys. If you have enjoyed this and got some value and you still haven't subscribed, it's now the time to. Smash that bell icon as well so you know exactly when I drop the next video. I'll catch you guys in the next one. Thanks guys.